Welcome back in to Rob Black and Your Money. It's time for us to ask the expert. And that expert would be CFP Chad Burton. CFP Chad Burton, you deal with financial planning issues. One of the issues that you deal with are challenges of retirement. Let's talk about 5 challenges people face with retirement. I just did a segment, Mr. Burton, where I talked about low interest rates moving a little bit higher. Can you expand on that for us?
Well, it's been a kind of a breakneck type of a relationship, especially since 2007, because traditionally retirees, they have somewhere between 30 and 70% of their portfolio in fixed income and CD type of investments. And interest rates on the 10-year Treasury were over 5% in 2007 before the big crash. And now they're at about 2.5%. At one point in May, it was down at 1.6%. It's been even lower. So it's been all over the place, which has made bond investing somewhat confusing. But at the same time, the income that retirees invest in products like CDs and bonds, the income has been cut. Back in May, it was 70%. Currently, it's about 50 to 60% lower than where it was in 2007. So that's a big issue for retirees, and it's forced people to kind of get more aggressive.
I think we have a chart of that 10-year Treasury note. Let's see if we can't pull that up. It's a graphic that's pretty shocking to see. You can see that it was trending lower for years and years and years and years, and then it spiked up in the last month. That spike is a big transition period.
Right.
The latest trend right now, Chad, is hunting for income stocks using high yields, and income for retirees is a big issue. Let's discuss that a little bit, of searching for high yield.
Well, a lot of people, because many stocks now have a higher dividend yield than the bonds, what happens is that a lot of retired investors have now pushed themselves into an area of more risk than they're really thinking about, because now that we've gone through so much upside, the market's been pretty much going straight up since 2009, people are becoming complacent with risk. So they've gone, their portfolios are much more aggressive than they're used to in the past. And so when interest rates rise rapidly like they did last month, what can happen is that they can get shocked. They can realize that, oh my gosh, I am now invested in too many stocks. Stocks do correct after all. So what happens is they end up panicking and selling at the wrong time when they end up taking too much risk. Now, it's okay to invest in a lot of dividend-paying stocks and have that income for retirement, as long as you don't panic out when times get a little bit uncertain.
We're going over the top 5 major retirement challenges today. One being higher interest rates. Income from bonds is incredibly low. 2 being is hunting for the replacement of income. 3 being is, when do you sell either a stock or a bond? When do you sell in retirement? Because the rules seem to be changing, Chad.
Yeah, when you're younger and you're building wealth, timing the market really isn't that important. When the market drops, it's going to be positive in the long term, so you buy more. But when you're retired, timing is everything, because you don't want to sell and create income when the market is down, whether that's stocks or bonds. So what you have to do is you have to go into retirement with 2 things. A pie chart in terms of your asset allocation, how much you should have in bonds versus stocks, and in stocks, small cap, mid cap, international, emerging market. And 2 things determine when you should sell. 1, the pie chart. If you go in and you say, you're supposed to have, let's say, this isn't advice, but as an example, you're supposed to have 25% in large cap, and all of a sudden that moves to 30% of your portfolio because that area has done so well. That's when you need to pull the trigger and create, sell some of the gains, reallocate. Yet the second piece is your cash goal. When you're going into retirement, you need at least 3 years worth of portfolio draws in cash. And so if you go through a good quarter and you say, okay, well, I've spent some of my cash, my portfolio's done well, well, you need to trim some off the top to replenish that cash, because you're always kind of preparing for that downturn in the market. Now, the market, is positive 70% of the time, but you're drawing 100% of the time, so you have to have a cash cushion for the bad years.
We've got about a little less than a minute, Chad. Why do we want 3 years of cash?
Well, the market has corrected 3 years in a row, only twice. So I've been in the business for almost 20 years. I've only seen 1 3-year correction. The other time when the market was negative 3 years in a row was right after the Great Depression. We've had a lot of 2 years in a row where it's been negative, but not 3 years in a row. But that could happen. You're retired for 35, 40 years. So you have to have that 3-year cash cushion. And then you have to invest the portfolio the right way to feed that cash. So the 3 years worth of cash cushion and the correct amount of dividend yield and interest yield in your portfolio will get you through about a 5 to 7 year kind of tough period in the market. We go through bull markets, we go through flat markets, we go through bear markets, and that cash is king during those times.
If you want to contact Chad, you can do it via telephone, 888-762-2423. That's 888-762-2423. Or you can go to newfocusfinancial.com. That's newfocusfinancial.com. When we come back on Rob Black and Your Money, we're going to be speaking more with CFP Chad Burton. A little later in the show, we'll be answering your questions. You can drop me an email, rob@robblack.com. Stay tuned. We'll be right back. Joining me again, CFP Chad Burton. Mr. Burton, we're talking about 5 major retirement mistakes. One of them is the low interest rates caused them not to save enough income. 2, the low interest rates caused retirees to go for higher risk income. 3 was tied towards when do you sell in a down market. There's down markets in retirement. But 4 is healthcare costs. What do we need to know about healthcare costs, Mr. Burton?
Well, it's a significant part of your budget. A lot of people retire thinking that they're going to get on Medicare and everything's going to be covered. That's just not the case, because when you retire, you get Medicare Part A for free, but Medicare Part B you have to pay for. That's $105 a month. It's right out of your Social Security check. Then you need a supplemental plan, because Medicare A and B doesn't really cover all of the office visits and major expenses like that. So that average Medicare supplemental plan that I see in retirement is usually around $210 a month. It's, could be cheaper when you start out, could be more expensive as you age and become less healthy, I guess you could say. But then there's all these other costs in retirement, and they average around $240 a month between your Medicare Part D, which is your prescription drug, or your co-pays and office visits and other things like that. So that's another around $240 a month. And then none of that covers a nursing home stay or home health care if you become incapacitated or need some help when you're a little bit older. So a lot of people need to get long-term care insurance. Long story short, any of my planners, when we do a financial plan, we add in anywhere from $600 to $850 a month in health insurance costs and health costs when you're in retirement. And that's usually what your employer is covering right now.
Let me bottom line that Social Security when you're retired comes out to about $20,000 a year. Then it gets taxed. Then you pay your health care cost out of it. So $20K might be $10K. Can you live on that in retirement? Probably not. It's a supplement. You need to save more. We're speaking with CFP Chad Burton, New Focus Financial. The 5th issue that we need to cover, I believe, is probably inflation, somewhere along those lines of what happens in retirement. Chad?
Well, yeah, a lot of people will project their retirement in terms of determining when they can retire and whether or not they have enough with a straight line in terms of expenses. And people live till they're 100 years old now, and even longer in some cases. So that means you're retired for 35 years. And the value of the dollar, because of inflation, is cut in half about every 18 years. So, if you're living off of $50,000 now, it's going to be $100,000 in 18 years. It's going to be, $200,000 and by the end of your retirement. So inflation is kind of the boogeyman in retirement. We've gone through a decade or two of really low inflation because of all the printing of money that's going on around the world. In 10 years, we could go through a period of really high inflation. So you need to prepare for that, make sure you've saved enough, and make sure you're in things that will help you fight inflation inside your portfolio, whether it's international stocks or bonds, things like that help get some currency exposure overseas rather than just the U.S.
Now, one of the things I like to bottom line for people is that for retirement, you want at least $1 million investable assets, because that'll pay you $40,000 to $60,000. But what you're saying is because of inflation, by the time you die or in the latter years, you almost need $2 million to pay that $40,000 to $60,000 in income. Is that correct?
Yeah, I mean, if you're saying the $1 million, it's all relative to your expenses, and that's
Absolutely.
really way too low for somebody that's 25, 35, even 40 years old that's trying to retire in the Bay Area with that amount of money. So it's relative to your expenses. You used to be able to retire at 65 and draw 4 or 5% of your portfolio. Even that's being challenged now because of what we talked about in the first part of the show, which is the interest rate on bonds. That was developed, that 4 and 5% rule was developed in the 90s when interest rates on CDs and bonds were a lot higher.
What are your thoughts on lifetime annuities? Good thing, bad thing?
They're a bad thing right now when it comes to giving up money to an insurance company and having it pay back to you over your life expectancy, because number one, interest rates are at an all-time low, so there'll be a better opportunity to do that later on. Number two, your heirs typically don't get anything after you pass away. And I don't like tying up money. I don't like, annuities because they're commission products in most cases. There's a couple no-load options that are okay, that are out there. But that traditional type of annuity that creates your own pension, right now is really not the time to do it at historically low rates.
Is there anything else that we need to know in 30 seconds or less?
Again, it comes to long-term care. Whether or not you need it, go to somebody that is a fee-based advisor, because somebody that's going to sell you the product or the insurance, they're going to give you biased advice. You want to know if you need it, but you don't want to know that from somebody that's going to make a commission.
Long-term care is, a position where nurses come to your home. My mom's 75 plus years old. She's used it 3 times at $100,000 a year. My dad kicked over dead before he was 60. He didn't need it. Sometimes it's more of a woman's issue. Would you agree?
Not necessarily, because here's the deal. I've heard you say that before, and a lot of times the guy goes into the nursing home, they spend a lot of money, and then the female lives longer on just the traditional basis, so they have less money in their portfolio to get them to age 100, so that's a problem.
Thanks very much. That's CFP Chad Burton. You can find him on phone, 888-762-2423. It's 888-762-2423, or newfocusfinancial.com. That's newfocusfinancial.com. Coming up on the show, I'm going to be answering your financial questions via email. Drop me an email, rob@robblack.com.
The news and views expressed on this program are not necessarily those of Cron TV, its management, or advertisers. Consult a broker or advisor before taking any action on the stocks mentioned on this program.